So I'm going to go over how to record different merchandising transactions. So in the first transaction, we sold merchandise on account to our customer, Sonia Mendez. We can see the terms, the credit terms, 1/10N/30. So if they pay within 10 days, they get a 1% discount. And so the shipping terms are FOB destination, which means we as the seller own the goods until they reach the buyer. That's the destination. So the seller, we're responsible for those shipping charges. And so to record this sale, and it's a sale on account, we're going to debit accounts receivable and credit sales. That's the revenue side of this transaction. We have to make a second journal entry to record the cost of goods sold side of the transaction. We have to update that our merchandise inventory went down by $3,600, and that's going to be our cost of goods sold. So our cost side of the transaction is we debit cost of goods sold, $3,600, and credit merchandise inventory, $3,600. Then we have to make a journal entry because we paid, let me make my screen bigger. We paid $100 in the transportation charges for the goods that we shipped to Sonia Mendez. So since we incurred these transportation charges as a seller, we're going to debit delivery expense for $100 and credit cash. Next transaction. We granted a $300 allowance to Sonia Mendez because there was damaged merchandise. So we said, well, just toss it or do whatever you want with that damaged merchandise. We'll take $300 off your bill since some of the items were damaged. So since we're taking an amount off of her bill, her account receivable is going to go down. Okay. And so we also need to record that this $300 really wasn't a sale because we're taking it off of what she owes us. So we need to reduce our sale, but we're not going to reduce the sales account directly. We're going to use a contra account, and that's what we're going to debit. So we're going to debit sales returns and allowances, $300, and credit accounts receivable. And we'll see the sales returns and allowances is going to be subtracted from sales to get to the net sales that we show on the income statement. But we want to use this contra account to track the amount that we're giving in returns and allowances to our customers. Next transaction, we purchase merchandise on account from DaCosta, and there's a discount if we pay our bill within 10 days. So we're purchasing merchandise on account. We'll debit merchandise inventory and credit accounts payable. Next transaction. We had to pay for the shipping charges on the merchandise we purchased from DaCosta. So the terms must have been FOB shipping point because we as the buyer have to pay those transportation charges. So when we pay transportation charges on merchandise we purchased, that becomes part of the cost of the merchandise inventory. So we debit merchandise inventory and we credit cash. Next, we purchase merchandise on account from Page Company. We'll debit merchandise inventory and we credit accounts payable to record that transaction. Next, we returned $1,000 of the merchandise for credit from the October 8th purchase, which is what we purchased from DaCosta Company. So we're returning the merchandise, so the merchandise inventory is going to go down since we're sending it back. But we're also not going to pay them for merchandise that we returned, so the accounts payable is also going to go down. So we debit accounts payable to make accounts payable to go down. We credit merchandise inventory to make merchandise inventory go down. Then on the 21st, we received the check from our customer, Sonia Mendez, for the October 7th sale, less the allowance and the discount. So we made the sale to Sonia Mendez for $6,300, but then we granted a $300 allowance because some of the merchandise was damaged. So her account receivable then dropped down to $6,000. Well, now she's paying off her accounts receivable. So we know we're going to be debiting accounts receivable. I'm sorry, we're going to be crediting accounts receivable because accounts receivable is going down. So accounts receivable is going to be credit for the $6,000. We're going to be debiting cash because she's paying us. Well, how much is she going to pay us? The terms were 1/10 and /30. That was on the 7th. We're getting the check on the 16th, so we're getting it within 10 days. So she gets to take a discount of 6,000 times 1%. $60. So the cash she's going to pay us is going to be, she's going to get to take $60 and only pay us $5,940. The debit for $60 is going to go to sales discounts because the sale really wasn't for $6,000, right? The sale was for $60 less, but we're not going to debit sales directly. We're going to use this contra account. So that's how we'll record that transaction. Then on the 20th, we're going to pay Page Company for the October 10th purchase, where we purchased merchandise account for $19,200. But there's a 2% discount if we pay within 10 days, which we're doing. So we don't have to pay the full $19,200. However, our full accounts payable is going to go away. So we're going to debit accounts payable to reduce our accounts payable by the full amount, but the amount that we need to pay is going to be 2% less. We're going to be able to take a discount equal to 2% of that $19,200. So $384 is going to be the discount. So the amount we have to pay is $19,200 minus the $384. We're going to pay $18,816. And this $384 discount that we're taking on our purchase of merchandise, we're going to credit merchandise inventory. Because we initially recorded the merchandise inventory as a debit of $19,200, but the merchandise inventory didn't cost us that. So we're going to credit it by $384, and then the net effect is we will have recorded our merchandise inventory at $18,816, which is what we actually paid for that merchandise inventory. And then our last transaction, we paid DaCosta for the balance owed on the October 8th and October 15th transactions. So we purchased merchandise on account for $8,500. On the 15th, we returned $1,000. So we don't owe $8,500, we returned $1,000, so now we owe $7,500. However, there's a 2% discount if we pay within 10 days, but look at, we're paying after 10 days. So we're going to have to pay the full $7,500. So that will just be a debit to accounts payable for $7,500 and a credit to cash because we did not get to take the discount.